Hello friends, welcome to today's session. In today's session, we are going to be learning about the rules of debit and credit as per the modern approach. In the previous video, if you have already watched it, you would have seen that I've taught you about the traditional approach. We talked about the classification of accounts into two types. First approach was a traditional approach, which I have discussed in the previous video, which was also known as the English approach. And now the other approach is the modern approach, which we will be learning today. This is also known as the American approach. Now we are learning this classification of accounts, and we will also be learning about the rules of debit and credit, which is required for us to pass a journal entries, which is actually the first step of the accounting process. That is passing of journal entry. So to pass journal entry, we need to know the rules of debit and credit as well as the classification of accounts. So let us start. The modern approach or the American approach. The accounts are classified under the modern classification as asset account, liability account, capital account, revenue account, expense account. So accounts are classified into these 5 categories. Now, what are included in these different types of accounts? Now, asset accounts. When we're talking about assets accounts, all those accounts that relate to our economic resources of our business. So, basically, it includes all of our tangible assets. We are talking about tangible and intangible assets that come under this particular category. Example, I'll give the example of land. We have building, we could have machinery, we could have items like cash, bank balance, we could have computers, vehicles, and so on. You have goodwill, patents. All these are examples of the items that would come under the asset account category. So when we open land account, building account, patents account, it comes under the asset account category. Now moving into liability account. What accounts will be opened under this category? So liability account, here normally whatever is owed by the business, that comes under the liability account. So you will have the lender's account. That is, you might have borrowed as a business, would have borrowed from banks, from financial institutions, or from individuals. So those accounts, when they're opened, they are opened under the liability account category. That is what we mean by lenders here. Other than that, we can have creditors for goods. Whatever the business, type of business, goods that they are dealing with, when that is purchased on credit, then it leads to creation of creditors, the person to whom the business will have to pay for the goods that it has purchased on credit. So those creditors account would be opened under the category of liability accounts. Other than that, you can have items like outstanding expenses. So your expenses like salary, rent, if it is not paid in a particular period and is to be paid later on, then that is owed by the business to that staff to whom salary is to be paid, or to the landowner or the building owner to whom the rent has to be paid. So these outstanding expenses are also classified under the liability account. So I hope that is clear. We'll move on. The third categorization is modern classification of account is capital account. So capital account, here we can talk about the proprietor's capital account, partner's capital account. So proprietors or partners capital account, the whatever amount they have invested in the business, that would go into this capital account. So amount invested by these people goes into this categorization of account. And the drawings account, you know what is drawings? Drawings is nothing but the withdrawals by the proprietor or the partner from the business for personal use. So drawings account also would come under the capital account category. Now the fourth classification is the revenue account. So the accounts related to the incomes and gains would be classified under the revenue accounts. Example, like we have the sales account. So if it is a trading concern, they buy and sell goods, the sales account is open under the revenue account category. There might be some commission received. If the business is being conducted on commission basis, then there would be commission received. So commission received account is under the income, so under the revenue category. Then there might be some investment made, so interest might be received, so that is also under the income, that is a revenue account category. Other than that, you can have items like discount received. When payment is being made, if a discount is received, less amount is to be paid, then that account would come here. Other example I can give you is bad debts recovered account. The bad debt which was written off as not receivable, if later on the debtor comes back and pays that amount is a gain. So that is a bad debt recovered account, which will be classified under revenue account. So these are certain items that would come under the revenue account. Finally, the fifth categorization is the expense account. So here we will have the accounts related to expenses and losses. So the examples for this could be the purchase account. So whatever is the item which is dealt with by the business, that is what we call as goods. When that is being purchased, that goes into the purchase account. Then we can have wages account, salaries account. Then we can have rent account, printing and stationery account, postage account, discount received was on the revenue, so discount allowed. If the business allows or gives discount, then that is discount allowed. That comes under the expense category. If there is a bad debt which is written off, then bad debt account. Then depreciation which is charged on the fixed assets. So these are all items that would come under the expense account category. So I hope with these examples, the modern classification of accounts is clear that there are 5 classification: asset account, liability account, capital account, revenue account, and expense account. So now, having understood the classification, now let us go and start learning the rules associated with these 5 types of accounts. Okay. So now I'm going to tabulate these rules of debit and credit so that you can make this table in your book, and just one glance at it will help you to recap the rules of debit and credit. So for the first type of account, that is our asset account. So assets account. Now for the assets account, what is the rule? Now, in case asset account is considered to have a debit balance. So, it is supposed to have a debit balance, and when there are increases in asset, it is going to be debited. So, when there is an increase, it is to be further debited. When there is a decrease, it is going to be credited. Second is our liability account. Liability account have a credit balance. So when there is an increase, further credit has to be given, and that is why the account would be credited with increases in liability. And when there is a decrease in liability, it would be debited. the opposite would be done so that it decreases. The third is our capital account. Capital accounts have credit balance. So when there is an increase, it would be credited. And when there's a decrease, the opposite, and that is why it has to be debited so that it decreases. Fourth, we have the revenue account. Revenue accounts have credit balance. So when there's an increase, it is going to be credited. And when there's a decrease, it is going to be debited. And finally, the last one is the expenses account. Expenses accounts are all debit balances. So when there is an increase in the expenses, the expense account is going to be debited, and when there is a decrease, it is going to be credited. So these are the rules of debit and credit associated with these 5 types of accounts. If you notice, the assets and the expenses have debit balances, and therefore when there is an increase in asset or increase in expense or expense is incurred, the accounts are going to be debited. And when there is a decrease, the opposite has to be done. The debit has to be reduced, so it is credited. And when you look at these 3 accounts, that is a liability, capital and revenue, those balances are going to be credit balances. So with every increase, again you have to credit it. So those accounts are credited with increase in liability or capital or revenue. And when there is a decrease in them, when the liability is decreased, capital is decreased or revenue decreases, you would have to do the opposite, and that is why we debit it. So this is an important observation which will help you to remember this better. So now, to understand these rules better, we will take suitable examples and do it. Like for the first example, we will discuss around 5 situations. First one is, suppose we take the example, Suresh started business with cash. Rupees 10 lakh. The first thing that you will have to identify as soon as you read the statement is the accounts that are involved in this transaction. Suresh is the proprietor of the business. He is starting the business with a cash of rupees 10 lakh. So here you notice that he is bringing in cash. So the accounts that are involved are cash and capital. Now, as per the classification, cash would come under the assets category. So it's an asset account, and capital is under the capital account category. So first step, we identified the 2 accounts involved, and then the categorization of the accounts. Cash being asset account, capital being capital account. Now we will go into the rules of debit and credit of these categories. For the asset, what is the rule? If you see here, the asset account, when there is an increase, it is debited, and when there is decrease, it is credited. And therefore, cash being an asset, what is happening here? Cash is being brought into the business. Therefore, cash is increasing. So, increases are debited. So, the entry would be cash account debit. Cash account is debited with 10 lakh rupees. Capital account. What is the rule associated with capital account? When there is an increase, it is credited and decreases are debited. Here, capital is being brought in, therefore capital is increasing, and therefore for capital increases, it is to be credited. So, we credit it. So, to capital account, 10 lakh. So, this is how we would be applying the rules of debit and credit. Being capital introduced would be the narration. So this brief description that we would be writing after the journal entry is called as narration. What is narration? It is just a brief description of what the transaction is about. Cash account debit to capital account 10 lakh. This entry is for the capital being introduced into the business by the proprietor. Now let us go to the next example. We'll take the next example of borrowed from Ramesh rupees 2 lakh. Now here 2 lakh has been borrowed from Ramesh. So as I told you, what are the accounts involved? The first step is to identify the accounts. The accounts involved are here money has been borrowed, so money is going to come in, so there is going to be cash. And the other account is the person who has lent it, the lender account. The lender account is here Ramesh. So he has lent. So cash account and Ramesh account is involved. Now let us go and classify under which category of account it comes. Cash account comes under assets account category and Ramesh is a lender. Now if you go back and see, lenders come under the liability account category. So this is a liability account. Once you have understood the accounts, now you have to just apply the rule. For the asset account, what is the rule? Try to remember it. The rule is increases are debited, decreases are credited. So here cash is being borrowed, money is coming in. So cash is increasing. So we would have to debit it. So cash account debit 2 lakh rupees. And the second account is Ramesh account, which is a liability account. Here money has been borrowed and therefore it is repayable to him. So liability is increasing here. So liability, when it increases, it is to be credited. So here we would have to credit loan from Ramesh account 2 lakh rupees. Being amount borrowed from Ramesh. So this is how we pass the journal entry and use the rules of debit and credit. Now let us go to the third example. Purchased computer rupees 1 lakh from Computer Mart. So for the business, computer was required and therefore 1 lakh rupees was spent on purchasing computer from Computer Mart. Here this transaction, first you have to identify the accounts involved here. One is obvious, computer is involved here. So there is computer. So accounts are, one is computer. The other one, whether money is being paid to get it or it's a credit transaction. So whether it's a cash or credit transaction, it's be identified. When we read it, we don't find the term cash anywhere, but we find the name Computer Mart, that is the supplier's name. And therefore, because of the absence of the term cash and presence of the term Computer Mart, the name of the supplier, we can assume that this is a credit transaction. And therefore, the other account is the Computer Mart. He is the creditor for the business because here a credit purchase has been made. Now, what is the type of account under which computer will come would be the next step. So identify. Computer is an asset account. Now what type of account would be Computer Mart account? Amount is payable in this case. For the amount, whatever computer purchase, 1 lakh is payable. Therefore, amount being payable, it would come under the liability account. Now, what is the rule associated with the asset account? The rule for asset account is increases would be debited and decreases would be credited, right? So here asset, what is happening? Computer has been purchased, computer is coming into the business. So computer asset is increasing, so you have to debit it. So we would debit computer account. So write computers account debit 1 lakh. The other one is a liability account. What is the rule related to liability account? The rule is when there is increases in liability, it is going to be credited, and when there is decrease in liability, it is going to be debited. Here, whether liability is increasing or decreasing. Here liability is being created because computer was purchased and 1 lakh is payable. So liability is increasing. So we have to credit it. So we have to credit the computer mart account. So right, by Mrs. Computer Mart account 1 lakh. Write the narration. Don't forget the narration. D. The computer purchased from Computer Mart. So this is how we would pass the entry. I hope that is clear. Let us move on. We will go to the next. Purchased goods rupees 1 lakh for cash. So now here goods have been purchased for 1 lakh rupees by paying cash. So identify the accounts that are involved here. Pause the video, think and then replay it. So have you guessed? The two accounts involved here are purchases account and cash account. Right. So purchase account, cash account are involved. Identify the classification of account under which category out of the 5 categories, under which category would the purchase account come. So if you can recall, it is under the expenses account category. And cash account we have done in the previous journal entry, so you might be very much aware it comes under the assets account category. Now remember the rules associated with these accounts. First, about the expenses account. Expenses account. The rule is when there is an increase in the expenses, it is going to be debited and decreases are credited. So here purchase is being made of goods, so purchase being expense is increasing. So we should debit the purchase account. So we'll write purchase account debit. And then the cash account. What is the rule related to the asset account? It is same as the expense account. So for the increases, it is going to be debited. And when there is a decrease in asset, it is going to be credited. So here what is happening? Cash is going to be paid. So what is happening? Asset is decreasing. So we have to credit it. In the previous example, you saw that the cash as an asset was increasing. So you're debiting it. But here money is going out. You're going to pay for the goods you have purchased. So it is being to be credited here. So it will be to cash account. So 1 lakh rupees is debited to purchase account and credited to cash account. B. Goods purchased for cash. Clear? Finally, one more we will do. Final one. Sold goods. for cash. Rupees 2 lakh. Now here, what are the accounts involved? The two accounts involved are, you are selling goods for cash. So you're going to get cash when you sell, and there is sales. So these are the two accounts involved, cash account and sales account. Hope you were able to identify those accounts. Now, what type of account? It will come under which category? Cash account comes under asset account. Sales account would come under revenue account. So now once we have identified the type of account, we will again recall the rules associated with it. Asset account. By now you might be knowing this by heart. Asset account, increases are debited and decreases are credited. Now for the revenue account. Revenue account, what is done in case there is increases? Increases are credited and decreases are debited. So now we will apply these rules here to form the journal entry. So cash being an asset account, cash is coming in, so it is increasing. So we have to debit it. So cash account debit 2 lakh. Sales being a revenue. Sales is also increasing. Revenue account, when it increases, it has to be credited. So to sales account 2 lakh being cash sales. So this is how we pass the journal entry, and this is how under the modern approach the step we follow is first read the transaction, analyze it and see the accounts involved. Once you have identified the accounts, then see under which five categories do they fall. Once you have identified those categories, recall the rules associated with that type of account and apply that rule and pass a journal entry. And don't forget to write the narration, which is a brief description of the transaction that has taken place. So with that, we come to the end of today's session. So if you found this video useful, please do like, share and subscribe. And if you have any doubt, please do leave your doubts in the comment section box, the comment box below, and I will get back to you at the earliest. Thank you. Have a great day.